Okay, let's have a look at what the market was doing this week. It is 7:24, 7 p.m. So the market's already closed. I'll pull up the little account here on Robinhood. When I left the shop this afternoon, I had to run to Serena and get a lawnmower. And then on the way from the shop to Serena, I decided I didn't want the lawnmower in the truck all weekend because I have to go fishing tomorrow. So I ran all the way back to Aurora and dropped that lawnmower up at the shop. That I didn't have time to come home and do this, and so you can see here that I already did it. I sent the $200 into the account, and then I rolled the $2 puts to next Friday instead of this Friday. And then I went ahead and I took the $4 puts and I rolled them to $2 puts. And then the $200 that I had put in today, I also sold another put. And so we have 5 puts here expiring next Friday at $2 for 35 cents. So that's what happened with that. And that's that. So I'll just go ahead and put that off to the side. And then we'll have a look at, what's going on with the markets in general. We did have earnings this week. We had Tesla and Google, and I do want to look at those. So I kind of want to get through, this stuff, like the Robinhood account here and stuff. I want to just get through it because it's no different this week than it was the week before. The week before, I sent the $200. I sold the puts. Same as last week, same as this week, same as next week, until it starts to move. Really, nothing's going to change there. Nothing's really gone up or down as far as dollars are concerned because nothing has really changed in the state of MSTU or MSTR or Bitcoin in these 5 weeks. There's really nothing much to talk about here, and I can just get on to the next thing. So go ahead and minimize that. Okay, and now we can get into what's happening here this week. And so, as like a whole, on this 3-year, 1-week chart on Bitcoin, we have, 1, 2, 3, 4, 5, 6, 7. It's like 8 weeks, I believe, in there. Yeah. 1, 2, 3, 4, 5, 6, 7, 8. So 8 weeks where basically it's just in this area, in this region here. Let me zoom that out and then scroll down. So it's just traveling across. Nothing's really changed, which is why the MSTR or the MSTU hasn't really changed. If we get like a larger breakout and close up here above 65,000, then there may be some, actual change, but for now it's mostly just sideways. And so MSTR and MSTU are also then mostly just sideways. Not really much to dig into with that. It's just mostly sideways, and so we'll just continue to go mostly sideways. MSTU is hanging around that $2 area because MSTR is generally hanging around like that $100-ish area, 91, 100, 105, somewhere in there. So the price hasn't really fluctuated enough to move it, that I'll just continue to DCA however many weeks that we get out of it. I'll just dollar cost average back into that with those $200. And I guess the longer it stays here, the more I'll be able to get in it. Because when it starts to move, then it starts to move, and then it's harder to buy it when you only have $200 coming in every Friday. So, we'll just watch that go sideways or up or down or wherever it goes. And when something changes, something changes. These 200-day moving average versus the Bollinger Band is obviously coming together at some point, and it's getting closer and closer. So, if we just kind of rough guess at it, it's a maybe 2 more weeks before something is signaled that there is a difference between today and 2 weeks from now. It's really just a guess. We're just waiting for this to come together, but roughly maybe 2 more weeks in it. Just according to this, roughly 2 more weeks, and then maybe we get some kind of upwards move. On the daily, it's kind of the same look. You're waiting for the 200 to come through here. This is getting squeezed in, so with the squeeze, there is like momentum developing, and then when it coils up, then this is gonna come out the other side of it, and this is gonna want to rise up to meet it. So we just wait for this to get squeezed together. We wait for the 200 to come back into it, and when it drops in, then we start to see this push upwards. But for now, it's mostly sideways consolidation. Just, sideways price action, accumulation happening in here, which is also exactly what we're doing. Just accumulating shares and acquiring them as they come across. So we're just in consolidation sideways, and then waiting for this to finally like come together and break, which again, maybe like 2 weeks from now, roughly. Something similar to this, where if I kind of zoom in there, it gets a little like convoluted with all of the other lines and mostly just all the other lines just jam-packed into here. But if I hover over the top of this, it's the red, the gold, and the green. And as it gets like squeezed tighter and tighter and tighter, and then when this comes out the other side, the expectation is that this is going to come up and get up into this region. It didn't. This is that major drop-off from like January. But this is kind of what I base everything on, is that it's going to come into here and try to pay off this inventory. It didn't, and so that's still the target. And if it breaks up this time, then it's going to want to come all the way up to here, which is where I get that $250 to $170 type of area. It wants to clean this inventory up here and like satisfy the pressure that existed there back in January. But looking for it to just come together, squeeze super tight, and imply some kind of major like springy volatility that's going to come in, and then get that price moving up and out of there. And then we got this squeezing in here, and then it moved up, and so then we're getting this squeezing in here, and I expect it to just move up into this area. Still potentially 2 weeks away that we're just acquiring shares or DCAing in every Friday until that happens, and potentially 2 more weeks of that. That's MSTR, that's Bitcoin, that is MSTU. And now I kind of want to look at what had happened on earnings. We had last week Netflix earnings, and then we had Tesla and Google on Wednesday. And then next Wednesday, we have Microsoft, we have Facebook, and the next day on Thursday, we have Apple and Amazon. So I want to cover those. Some of the earnings we already had, some of the ones are coming next week. So in the middle of the week, next Wednesday, I want to be prepared for what's happening then. And then obviously what already happened this week and the week before, I want to look at those as well. We already know that we're buying MSTU, and we're buying MSTU under $3. So no really need to keep looking at that one. And I'll just move on to Facebook. Who is it? Oh, no. Google. We'll move on to Google, Tesla, and Netflix and have a look at what they're doing. So starting with Google here, we had a very large drop down. Off of the earnings, there was a massive gap down the day of earnings after the close. They announced the earnings after the close, then Google instantly dropped down and then just moved sideways after earnings. So it's definitively down and definitively beat up down here, and didn't have any kind of rebound or anything. It's just down. Earnings, as far as the dollars per share are concerned, came out really well. They beat earnings, they beat revenue, they had a beat on all of their financials. The thing that had hurt Google is their expectations on capital expenditures. So actually, let me Google the FinViz, because I'm going to want that for reference. FinViz, yes. And we want to look at Google, because there's something to talk about here for their earnings. Okay, so their earnings came out well, and then it dropped. So their PE ratio, their price to earnings, dropped from 22 to 16. I mean, the price itself got cratered. The earnings came out really well, and so the price to earnings ratio dropped from a 22 to a 16. Everything is green. Everything, as far as like earnings per share, this year is up 80%. Earnings per share for the past 3 to 5 years is up 30% and 30%. Whereas quarter over quarter here. Earnings per share quarter over quarter is up 300%. So this July versus their last July is up. This July versus 3 months ago is up. Everything is up, and everything is like green and golden for Google. They're a juggernaut of a company. They are profitable. They make money. They are extraordinary. Like they're excellent. What hurt them is capital expenditure. You potentially may see talks on the news or articles about CapEx spending. And when we reference their forward PE, which is going to be their next fiscal year, the PE ratio is at a 21, which means that they do not expect to make money next year. Between now and 12 months from now, Google has announced that they do not expect to make money. So their earnings will be good. Their earnings will be green. They will continue on the chart to make like $9.11 versus $5.11 versus $2.82, $2.87, $2.31, $2.81. If we look at like this is January, well, it's actually February, but February is $2.15. This year it was $2.82. Their April was $2.81. This year it was $5.11. Last year's July was $2.31. This year it's $9.11. I mean, they make money. They're such a good company. It's excellent what they are doing as a business. So they expect that to continue. But they then expect to take that money and spend it. That is their plan, and that's kind of what they announced, which is why the price to earnings is so lopsided when it comes from this year to next year. If we look at something like, let's just say Microsoft as an example, this year's PE is 22. Like currently, right now, their current price to earnings is 22 or 23, 22.73. Their forward is 19.6. It's because they expect to continue to make more money quarter over quarter and year over year, that their forward next year's price to earnings, if they judged it off of today's price, is expected to go down from 22 to 19. Google is the opposite. And that's where they got hit on their stock price. It's not that Google is a bad company. It's not that anything dramatic happened with their earnings. Here, it's not like anything bad had happened. They beat on revenue by what is that, like $2 billion, estimated $117 billion. They made $119 billion. And then revenue or earnings per share, they expected to make 2.87 per share, and they made 9.11. So everything is up and green for Google. It is solely that they expect to lose money next year or over the next 12 months. Now, they'll still bring in money. They will still be profiting. They will still be making money per share, but they are immediately going to take that money and spend it on investing in their own future by developing like data centers or increasing their AI infrastructure. That's basically what they said. We are going to spend this money. I believe that the number was 190 billion. Let me check the news, not that one. So here's the news, and I want to say it was like 190 billion, and that they had increased it from 190 billion to 220 billion. I don't actually immediately see it, but either way, that's what the drop off is that they had announced that the PE or the amount that they expect to make over the next year is going to be less because they're going to spend that money. And so therefore their forward PE is now 21. They were trading prior to earnings today at 22. And so they kind of just adjusted the price and said, well, if this is who we are right now, and that's what we're going to be next year, and there is no real potential upside to it, we might as well drop the price and call it forward PE 22 next year, same as 22 this year. So that is the difference in the reflection in the price of Google if we were considering their earnings. Knowing that, if we wanted to buy this drop off here, we certainly could. And I mean, I'm going to personally, I'm going to be buying Google. I want and have wanted to be able to buy Google for a while, and I wanted a price that at least on the chart made me feel good about it. Currently, it's a 16 PE ratio. By next year, it should be a 20. It should be a 22. But my expectation is that they should, in general, sit around a 30. And so if from 20 to 30 is a 50% move, that from where they currently are at 320 plus 50%, let's call it $150, that would be 470. That by this time next year, on a 30 PE, I would expect to see 470 on Google. That I still feel good about this price, and I personally am going to start buying it. It's low on the chart. The PE, whether it's this year's PE or next year's forward PE, both look good to me, and I want to see them upwards of 30 to 34 anyway. That I'm okay with the CapEx spending and with knowing that they are technically not making money over the next years because they plan to use that cash for something that will make the company stronger down the road. So long as I understand what they're doing with it and I understand what is happening and the cause for the drop, and I can rationalize it and justify it to myself, then I am willing to buy this. And so I'm going to buy Google off of this drop, and I'll just DCA into this for the foreseeable future. I guess so long as it stays under, let's call it 330, I could just draw a line there. So roughly this line, I didn't draw in there. Roughly this line right here, that if Google is under here for the foreseeable future, anytime, any Friday that Google is under this line, I intend to buy it. There is no expectation that it's going to be 12 weeks of buying or 24 weeks of buying, that I'll be doing this for 3 months or 12 months. For me, it will be that I don't actually expect Google to recover back into here and actually acquire that 470 until at least 12 months from now. That whatever pricing this goes, I am buying for a year from now, not for the expectation that it'll recover in 12 weeks or 24 weeks. So knowing that time frame and knowing that timeline, if somebody else wants to buy Google or wants to start acquiring shares, know that my intention for this has no real upside until next year, in my mind and in my opinion. So I mean, I just drew this new line on the weekly because this one's kind of steep on the yearly. So I'm going to go ahead and remove that one, and it's going to be this red line right here. So let me color that green. So anything right on the mean line, right on the mean on the long-term 3 or 1 week chart. If Google is under here, I plan to buy it, and I don't in my mind have any short-term outlook or short-term bullish recovery scenario for it. I am purely buying it because I want to be an owner of Google, and I don't believe that I will be getting these prices very often. That if I can buy this every Friday for the next 6 months or every Friday for the next 9 months, and this drops off from 319 to say 300, potentially down to 244, and fill out this large 3 or 1 week drop, I want to do that. For me, I want to buy this. On its long-term chart, it does maintain this trend very well, that I am confident in Google and in Google's future, and its, continued existence in the world market, that, if it's offering me prices here versus what it was a couple of months ago at 404, I want this and I don't want to miss it. And so Google is going to be something that I buy every Friday, with no immediate upside argument that it's going to do something great or incredible in the next 12 months or in the next 12 weeks or 24 weeks. This for me is going to be long term. It's going to be something that I'll just buy and hold for at minimum a year and then decide when it's going to happen with it. But for now, that's the line, and anything under here I intend to buy. Where is Tesla? So Tesla also had a big drop off. You can see it here from the big red candle. So Tesla, it was immediately a buy. I'm not buying it. That's a me thing where I would say yes, absolutely buy Tesla right now. My thing is that I already own Tesla. I own a lot of Tesla. And I own Tesla from years ago. That my average on Tesla means that I never actually need to look at it or care about the price of Tesla ever again. So just for me, I'm not buying this. But the pricing opportunity of it is technically equal to where I bought it. I bought it all the way back here in 2022, 2023. This drop off when Elon had sold shares to acquire Twitter. That's what this big ass drop off is here. I bought all of this, and I bought it every Friday for, God, what was it? Maybe like November, December, all the way until like May or June. So what is that? November, December, January, February, March, April, May, June. Yeah, we'll call it 8 months. That I had 8 months of Fridays. Every single Friday, I bought Tesla. Because Tesla specifically is my favorite company. Out of all of the companies in the list, Tesla is my favorite. And I wanted to own this like really badly. And so when this had this big drop off, I just dove into it every Friday without question, without any concern about the future of Tesla, because I fully believe in the potential of what Tesla is going to bring to the world. That I bought all of this back in 2022, 2023, and it's climbed ever since. And I don't really ever have to buy it again because I have so much of it, and I could not be more happy with my position in Tesla. But if somebody was looking for an entry and looking to get started on Tesla, I started buying what amounts to this half a standard deviation away to a full deviation away on this large chart, and it is currently a half a standard deviation away. So it's technically today a similar opportunity as what I had before. And what I bought here is the same as what happened here from, January 2024 until October of 2024. And this pricing here from February until April of 2025, and then it's kind of starting again here. That if somebody wanted to make an entry on Tesla and get started on Tesla and start acquiring shares on Tesla, I am always top priority of the list that yes, somebody should buy Tesla, mostly because this is my favorite company. So know that I am extremely biased on my opinions of Tesla, but the chart is the chart, and so the chart also confirms you could buy this. We'll go back to the daily here. So yeah, obviously it's a big drop off. It is 2 full standard deviations away, almost 2.5 standard deviations away from its mean pricing over the last year. That statistically speaking, this price should only exist for less than 1%. It's like 0.3% of all of the data collected should exist outside of these bounds here. That this should not be very long lasting, and should at least get back in and above 334 in the short term, which as a move is 4% up, 5% up, which isn't much, but this is extremely, extremely down. The reasoning for why it was down, I listened to the earnings call because I really like Tesla, and so I listened to their earnings call on the drive home. And what I could kind of figure out from it without sounding like a terrible person, and I mean, I'll tell you why. There was a lot of Indians in their upper leadership of Tesla, and for the life of me, I could not understand the accent, so I had an extremely difficult time understanding what they were saying because the accents were not very user friendly. But mostly what I could get from it is that Tesla's fine, but they also are going to have capital expenditures. They're going to be spending a lot of money. They're going to have to invest in their own future, and so they are going to take their profits and take their earnings and turn it around and utilize it, that their future earnings are not going to look as good as they could because they plan to spend the money, and they are still working on Robotaxi and their AI development. We're going to close that. I don't want it. Their PE currently is 390. Their forward PE is 134. So they still expect to grow and do much better next year, over the next 12 months. That on this large drop-off, they still expect to double, effectively double. Because 134 times 2 is 260, 270. That it's basically double. So they still expect to double who they are as a company from this year to next year. That this big drop-off is completely okay to me. That I can sweep this under the rug and say not a big deal. I fully endorse buying this, and it's my favorite company, so I actually don't want to say too much and make it seem like my opinions versus facts and reality are different. That I really won't get into that, but chart wise, it's a good buy, and I would buy this, except that I already have some. I guess I could look at the PE here. It looks extraordinarily high, so I guess I should explain that as well. So if we look at the history of Tesla, going back 10 years, we don't actually need to go back 10 years. It's 2019. So they were trading here at a pretty respectable PE for who they are as a company, at like, let's say $100 to $56. What had happened between here and this peak here at 308 back then, but back then it was actually 900. They had a stock split, which it's right here. It's a 5-to-1 stock split. But I remember this 300 was actually 900 at that time. So maybe actually not this one. If it was a 5-to-1, it would have been back here somewhere. So back here somewhere, the price was 900. It was not like 134. Either way, what had happened was they got added to the S&P 500. So they had a respectable PE, something completely fair and reasonable at that time for a price to earnings. You know, what they made it as a company versus what their price was looked completely fair and realistic. Then what had happened was they got added to the S&P 500. When they got added to the S&P 500, the S&P is required to buy a certain amount of shares so that they are fairly weighted against all the other companies that are already in the S&P 500. So the S&P 500 had to buy, let's say, 1 million shares. I don't know what the exact number is because it's differentially weighted versus who else is also in the S&P 500, but let's just say 1 million. So 1 million shares suddenly were taken off the market, and that made the price go up. But the S&P 500 is not the only thing out there that reflects the S&P 500. The SPY reflects the S&P 500. It's an ETF mirror of the S&P 500 at like 2x leverage. Maybe not 2x. I don't actually know what the leverage difference is, but basically the SPY is poor people's S&P 500. So they also had to buy an equal weight of Tesla shares so that they properly reflected the weight of Tesla versus all the other companies in the S&P 500. And then, like, the SPY had to do it, the SPX had to do it, all of the ETFs that reflect the S&P 500 had to do it. And what that boils down to is, instead of 1 million shares, there was 10 million shares. 10 times as many had to be just taken off the market and buried and vaulted into the SPY and the S&P and every trust fund out there that matches or mirrors the S&P 500. The inverse ones, the ones that want to mirror it in the opposite direction for implied downside shorting availability, they all had to do it. And so instead of 1 million shares, it was 10 million shares. But instead it's actually like 1 billion shares or 10 billion shares. It was a massive amount of shares. That happened at Tesla 150. Tesla had announced that they were getting added to the S&P 500. That happened at Tesla $150. And so then massive buying happened and climbed this all the way up to $300. And that, at that time, was effectively the absolute floor of what Tesla could get below, was Tesla 150. And that should, today, still be the absolute floor that Tesla could ever get below, is Tesla 150. Because that was the moment that they got added to the S&P 500. But because all of those shares got vaulted and buried in the S&P 500, it skyrocketed their price to earnings, because the price now could never get back below 150. And so it's always going to have a price to earnings that is extraordinarily high. The only reason that Tesla's PE is that high versus, say, Apple is because this is only 6 years ago. If we looked at the PE ratio of Apple at the time that they got added to the S&P 500, it would be the same story, because Tesla is a very, very young company. Apple or Google, Facebook, those are early 2000s companies. They had their IPOs and their initial public releases in like the 90s, that we're talking 35 years ago. They have had a chance to grow, lower their PE, and mature, grow into the price that they were inflated to after being added into the S&P 500. So if you ever see somebody talking about the PE and how high it is on Tesla, know that that is the reason why. The reason that this is so high and can't really be used as a proper judge of what Tesla is doing is because they got added to the S&P 500. Massive amount of shares were bought. The price was pushed very, very high because those shares got just bought at whatever price was available to acquire them and vault them away and have it properly weighted in the S&P 500, that this PE is very high. In, let's say, 10 years, let's say that we divide this by 2, so that its forward PE is 134. And then the year after that, they double again as a company. Then instead of 134, we're looking at 165, or we're looking at 65 or 70. Then the year after that, we're looking at 30 to 35. So possibly in 5 years or 10 years, depending on Tesla's growth, this PE may finally get down to something that is actually a reasonable number, something like 35, 30, 20, something like that. But for now, you can't actually look at this and use it the way that it is intended, because Tesla's maturity is very, very low. It's only a 6-year-old company. It's actually much older than that, but as far as its IPO and then its addition to the S&P 500 and how messed up the chart got beyond that, you can't really use it. But we can still look at it and say its PE right now is 290, its forward PE is 134. They essentially plan to double who they are as a company between now and next year. that is a good thing, and check yes for I believe them, and that the trajectory of the chart will continue to go upwards, that yes, I would buy Tesla, and I would buy it anywhere sub 311. I think my actual number was 300, that if I was telling somebody that they should buy Tesla, it's anything sub 300. That anytime you see a price under 300, it's very, very worth it to buy Tesla. And if I just drew this line and then said anything under here, then anything under here is good. And so anything under 317 is good. It's a made-up number. What's the difference between 317 and 300? But either way, check yes to Tesla. Yes, I would buy this, except that I personally already have a lot of it, and I couldn't be more happy as a shareholder of it that I'm not actually going to buy this. But if somebody else did, yes, like absolutely. We can look at Netflix now. So Netflix is down, undeniably down. They are, as a company, they're doing fine. If we look up there, let's just look at, because we'll look at Netflix. So PE 22 for PE 18.4. That's a potential upside of, let's say, 20 to 30% just to get back to a 22. Again, I would like to see them somewhere near 30. If they could do something like 28, 27, maybe like 10% off of 30, then a year from now, forward PE is 18. We'll call it $2 for easy math, and we'll call that actually 19 for easy math too. We'll go 19 to 21, 23, 25, 27, 29 is 50%. You should expect at least a 50% upside minimum on Netflix, and 50% from here gets us from 70 plus 35 gets us to 105. I still believe that it should get to 150, but the reality of that happening by the end of the year, with the sentiment and the way that things are going and the talking about Netflix currently, is that it's probably not going to be able to reverse its psychological effect on the public and retail buyers in that time frame. That I would more realistically shoot long term. That I had said earlier in the week to some other people that I would not plan on Netflix getting to that 150 or that 130, 125 mark by January. I would expect this to be a full 12-month hold. And yes, we've already at this point been buying for almost 12 months, that this is now turning into a 2-year plan. That whatever this drop down is here, from 134 down to, say, 66, is not going to recover until July of next year. And that's if it starts to recover, today. If it starts to do something that shows any sign of life, that would be a recovery to July of next year. I do not believe that Netflix is a bad company. Their earnings and their PE show that they are not a bad company. It's mostly green. Earnings per share this year is up 42%. Where is year over year and quarter over quarter? So quarter over quarter is up 10%. This year is up 42%. Is there anything else in here to really look at? They're not like astounding numbers. They're not like blow you away numbers like Google or Tesla would have. They're not blow you away numbers like Microsoft would have, but they are not a bad company as far as how the company runs. Do they make money? Yes. Do they have like an upward trajectory on their GAAP earnings per share? Yes. This chart obviously moves upwards. They typically make more year over year. If it was 2018 at 27, 2019 at 41, then 61, 112, $1, 120, 198, 253, 317. These numbers, except for like 2021, 22, 23, they're kind of tight, but mostly the company does do better year over year, quarter over quarter, long term. Their sales continue to grow year over year from 2018 to 2025, and then this year, from 2018, 15.79, which that would be in billions. They grow. They are a growing company. They are going upwards. They are performing well, and they're performing at a general rate of 30-ish percent, 35% year over year, and 10% quarter over quarter. Growth in sales, 13%. That all of this comes out to mean and say that they are a good company. The sentiment around Netflix is, as an opinion and based on the news, which isn't generally how I view things, that they are not a good company. In the current era, 2025, 2026, the opinions of regular people and retail who are buying this is that Netflix is bad. It's not necessarily true, and I don't really want to go into all of that because then I would rant for an extremely long time about unimportant things, and then I would my own opinions on unimportant things that really doesn't matter or have any real bearing on numbers and charts. So we'll just strictly stick to the math and the numbers and the charts, and that Netflix is a good company, and that in the future they will go up, and that long term they will continue to grow and have an upwards trajectory chart. That, let me draw from like here to here on the 10-year week. Let's try to follow this line as like a more reasonable expectation of who they are and what they're doing. How long did this last? If this in their past was November 2021, bottomed in May of 2022, that is 6 months and then an eternity of climbing. So down for 6 months, and then, what is that? June of 2022 till June of 2025. That is 3 years of climbing, where they just went up for 3 years. So if I looked at it from here and said June of 2025 to February 2026, and now currently August of 2026, I do not know when this will end. But when it ends, I would expect something like this, where then it just climbs. It just starts slowly traveling upwards. The angle of this isn't very steep. It's not a very tall mountain. It doesn't go straight up and parabolic and, won't ring any bells for rocket ship moonsies and, blast off all sorts of cool memes and stuff. But it is definitely a buy. Like, it is certainly a good price on Netflix, and that the future of that company is not going anywhere, and that all of their financials and all of their charts say that they do go up and they do grow and they do make money. And whether or not I believe that they are doing exactly what I think they should be doing is a completely different argument. From a chart and profit and earnings perspective, revenue and sales perspective, they're a good company and they can be bought here. So if somebody wants to continue to buy Netflix, by all means, go ahead. This is going to be the same as Google. Go ahead and put that in the Google category, where you're going to buy it every Friday with no expectation of some like parabolic rocket ship to the moon, V-shaped recovery in the short term. That this is going to be at least another year. That would be like my outlook, and my plan would be that, yes, we've already bought it for a year, plan for another one. So 24 months total of figuring out what Netflix wants to do for it to change its change its course and change its public image and turn the corner and get around, plan on another 12 months. So I think I can just vault this one, put it to the side, and say anything. Oh, let's just draw it through here on a long term, on a weekly chart. Anything under $75. You can buy it every Friday, acquire shares, and plan for a long-term 12 months deal. And yes, I do know that we've already been in it for 12 months. Like, I'm fully aware that we've already been in it for 12 months. We'll just buy it down here, lower that average, plan for long-term holdings, and we'll revisit this one if it ever does pop up. But and if it does decide to turn around and start climbing, maybe I will pull it back up and put it into the forefront. But for now, it's basically just a blind buy under $75 with no real expectation of near-term returns. But that when it does return, we'll be looking at least a return to 100 to get some kind of life back into it before it's even worth saying, oh, hey, Netflix is alive again. We want to see it at least get back to 100. There is this when showing up here on the 3-year 1 week chart that should be coming together and potentially could get us all the way back up to 96 and then try to pay out the 110. If that does happen, I don't know if it will, but if it does happen in the short term, then we're back on the bull. Like, then everything I said doesn't matter, and we're back on the bull, and we're back into the 100 plus areas, and then rocket ship moonsies, I guess. But if not, plan on another 12 months. So yeah, that's Netflix. It's down. Obviously, it's down. We'll just DCA into this on anything under $75 and continue to acquire shares. I will lump this in with Google. Plan on 12 months from now, see this one next summer. Who else did we have? We have Meta earnings coming up and Microsoft earnings coming up. Microsoft continues to be a buy. It has been a buy for many, many months. It's very down, and just this is essentially turning into what I think Google is going to be this year, where we just buy this. Microsoft is a great company. We don't really have earnings to look at because earnings is next week, so there's nothing really to go over here yet. But we do know that their PE is currently 22 and their forward PE is 19. So obviously I think this is going to go up. But we'll have more to look at next week after they have their earnings. But we have been buying this, and we've been dollar cost averaging into this since maybe January. So this will be I think this will be 9 months, 9 months, every Friday for 9 months. Been DCAing into this, that everybody should have a reasonable and respectable amount of shares of Microsoft and be prepared for when this does want to return upwards. So we have Microsoft, and we have it at a really good price, and long term, obviously they are a good company and they go upwards. And so I am super excited about these earnings. If their chart here continues to travel upwards, then we're looking at 500 by the end of the year. We're currently at 380. So the upside there is pretty substantial. And, I am more than happy to keep buying this at these prices here. So yes to Microsoft, and we'll see what happens with earnings next year or next week. And same with Meta. Yes to Meta. Same concept as Microsoft, really, where yes, it's a good company. Yes, they make money. We have earnings next week. We'll get to see what their earnings are this quarter. But if it continues to be down like this, then I'm just going to continue to buy it. Because they are going to continue to make money year over year and quarter over quarter. So we will revisit this next Friday after their earnings on Wednesday. But we've been DCAing into Meta, and it continues to be a good price, and so I would just continue to keep buying this every Friday. We will see what happens next week, but for now, Microsoft and Meta are still a buy, and we will revisit that next week. So on the current shopping list, we have Google, we have Netflix, we have Tesla, and we have Microsoft and Meta. We have five of the Mag 7 in buyable territory, where it's like completely green light, buy these. 5 of the 7 on the Mag 7, which is kind of crazy because usually something is up and something is down, and not all of them. Apple is still high. We'll see what happens on their earnings. That's going to be on Thursday at 7:30. And Amazon is also 7:30, I believe. Yes. So Amazon will also have earnings on the same day Apple does, which is next Thursday. So we will see if they go up or they go down. And if they go down, they will also be added to the shopping list. If they go up, then they will not be on the shopping list. Same thing with Apple. If Apple comes down, it's going to have to come down a lot. To get Apple into the shopping list territory, I would want to see it somewhere around 250. At the current price of 330, that would be 10% down is 30%, 10% more is 270. So it'd have to drop like 30% off of earnings. Do I think it's going to? Not really. But is that the price that I want to pay if I'm buying Apple? Yes. So, unless that happens, Apple's not making the shopping list this quarter. So, very unlikely that Apple's going to just drop off. I don't even know what their financials look like right now. 40 PE, forward 34. Yeah, they don't really have a whole lot of upside. They really only have downside threat. You saw the other ones that were 20, 22. That if Apple wanted to do something like that, if for some reason their earnings come out and they have some kind of announcement about their own capital expenditures and that they're going to be investing money in their future and that the earnings will not look good for the next 12 months, and then we see them get cut in half from 40 to 20, then you would see this price get cut in half from 330 down to like 180 or something, which is, yeah, down in here. Let's call it 200. So, barring any major earnings announcements, either we are not going to buy Apple because it's going to be 330, or we're going to be buying Apple because it's going to get cratered and put all the way down to 200. So look for either of those. Somewhere either north of 330 or south of 200. It's a massive and drastic difference, and I am not expecting or predicting any of that to happen. But if something does happen, that's what it'll be. Do I think it'll happen? Absolutely not. But also, yes, possibly, because that's exactly what Google had did and what Tesla had did. So possibly, but also not really. So it's not the plan. It's not anything I have like an actual ambitions to pursue or think that that's going to happen next Thursday. But if we wake up Friday morning and Apple is at 200, it's immediately going on the shopping list. If it's not at 200, then it's going to be at 330 still, and nothing's changed, and I don't plan on buying it. Could probably expect the same thing for Amazon. Really, that unless something drastic changes, probably not going to add it to the shopping list. We already have quite a few companies. We have 5 of the 7, and then 2 weeks after that, we have Nvidia on 8/26. That's like a month. That's 4 weeks. 4 weeks after those guys have earnings, then Nvidia has earnings. And so if Nvidia has earnings and Nvidia drops down, I will also be adding that to the shopping list. So yeah, that's it. Just waiting and anticipating the earnings for next week, and already knowing that I'm going to buy Google, and I am going to buy Netflix, and you can buy Tesla. Like, Tesla is a yes, and Microsoft is still a yes until next week at least, and Meta is still a yes until next week at least. So 5 out of the 7 in the Mag 7 are immediately viable. And we will find out about the other 2 after on the other side of earnings. So yeah, that's the video, and that's kind of it.